Now we will discuss about the cash flow statement. Cash flow statement is one of the financial statement but generally overlooked. The financial statement consists of income statement or what we call the profit and loss account, balance sheet and cash flow statement. As you know, income statement gives us an overview of profit and revenue over a period of time, whereas the balance sheet is a snapshot of business transaction. Now understand the cash flow. So cash flow tells about how the business managing its cash. So if you want to know about the cash position of a company, you can go into the balance sheet and check the cash and bank balance. It gives you the cash position of a company. But you will not come to know about how the cash is coming into the business and how the cash going out of the business. So for that, we need to understand the cash flow statement. Let's start. Cash flow consists of three main parts, that is cash flow from operating activities, cash flow from financing activities and cash flow from investing activities. So let's understand one by one. First, talk about the cash from operating activities. Cash from operating activities. As its name suggests, cash from operations. So operation means what company is having the product or services to offer to the customers. So when the company is selling its goods or services and getting the cash into the business, that is cash inflow from operating activities. So whatever company paying to generate that product and services, that is the salaries, the paying to the suppliers, the material cost and all, that are the operation expenses. So whatever the cash coming into the business from the operations minus what the cash going out of the business for operations, that is cash inflow, net cash inflow from operating activities. We can understand the cash flow like this. As we know, the net income does not equal to the cash because there are some non-cash items also. So there are two methods to calculate the cash from operating activities. The one is direct method, other is indirect method. First, talk about the indirect method. As we know, the net income does not equal to cash because there are some non-cash items. So when we add back the non-cash items to the net income and arrive to the cash from operating activities, that is called the indirect method of cash from operating activities. So the non-cash items are depreciation and amortization, increase and decrease in creditors and debtors, and increase and decrease in inventory. The other method is direct method. In the direct method, we take the cash from generation from the operating activities and what we have paid in relation to that operations. So this is the direct method. Both the methods are accepted by the accounting principles. Indirect method is linked to the profit and loss and balance sheet, and it is used by the most of the companies, whereas direct method gives the better insight, but it is very time consuming at the same time. So generally, indirect method is preferred by the companies. So now we will talk about the cash from investing activities. As we do the business, we invest in some kind of assets just like plants, properties, furniture and land. So when we buy the assets for the business, that is an investment activities. So when we buy the assets or the other businesses, the cash goes out of the company. So that is the cash outflow for the investment activities. When we sell the assets, that is considered as a cash inflow from the investing activities. Now we'll discuss about the cash flow from financing activities. So when we raise the capital, the equity as well as the loan, the cash come into the business. That is called the cash from financing activities. And when we repay the loans or buy back our own shares or we pay the dividend, that is considered as a cash outflow from the financing activities. So these are the three sections of the cash flow statement that gives the overview of the cash flow of the business. When we calculate the cash flow of the company, then we take the opening cash of the company, then cash flow from the operating activities, investing activities and the financial activities, and that comes to the closing balance of cash that you can see into the balance sheet. So by seeing the cash flow of the company, we can see that how the company is performing. When we see the profit and loss account, maybe the company is growing in his revenues, but when the company is selling all its product on the credit basis, the cash is not coming into the business, then it is difficult for the business to survive, because it has its expenses, it has its commitment, it has some taxes to pay, it has some salaries to pay. So it has some fixed cash outflow, and the cash is not coming into the company, so it is very difficult for the company to survive. So whenever you read the financial statement, it is important to see the cash flow of the company, and most importantly, cash from operation must be there. The positive cash flow from the operation must be there for a good company, for a good business. So this is about the basic understanding of the cash flow statement. Thank you.